All right, guys, welcome back to Basics. Shouldn't seem like a big break for you guys, but it is for us. And so this is now my lovely wife, Jessica, not my fiance anymore. We got married in the meantime. But this is where we're teaching Jess, who's never traded before, never really had any experience with the stock market, about trading. I've lost count the episode, but we're into the 30s now, so check out these two channels below. All of the episodes will be there. They're all in a playlist, so you can watch them from what is a stock to where we are now, where we have 3 official lessons left. And then they'll be changing a bit into just paper trading. Are you excited?
Oh, yeah. I'm already paper trading a bit.
Yeah, but you don't have a plan. That's
No.
what. So the next
But
3
I'm up.
episodes
I'm up.
are
I'm up.
an old saying in the markets that's don't confuse brains for a bull market. And it just means we've been rocketing ever since the whole COVID lows. So what we're going to cover in the last 3 lessons is going to be what you need to construct a trading plan. And then what I think we're going to do that's actually cool, that's something that I haven't seen before, is we're actually going to sit down and record the construction of your trading plan.
All
So
right.
this will be, for you guys who have stuck with us this long, this is the most valuable part. This is the kind of, everything else to date is kind of like an intro lesson about the markets, about how stocks move, things like this. This is actually the mechanics of placing trades, putting stop losses. This is kind of how you make money. So I put in the wrap up. We talked in the last little bit a lot about risk management, a lot about the fact I hammered the table, but it's the holy grail of trading really is managing risk and controlling risk. So we had some quotes about how even if you're the best trader in the world, you're going to be right half the time, give or take. And then I ran this graph, which was just 4 random studies basically of a 50-50 win rate strategy where it had a 2-to-1 risk reward, just showing that they all made a bunch of money over time. So now we're going to go one step further and we're going to talk about our multiple compounding, which sounds complicated, but it's really not. First, we got to go with what is compounding. And the easiest way to talk about this is with interest, right? And I know we've chatted about this a little bit, but you're still a little fuzzy on the details. Yeah. But
math is not my forte, folks.
No.
By any.
Well, this is the.
Thank you. Thanks for clarifying.
But this is the last math kind of thing. Compound interest is kind of, I think Warren Buffett called it the 8th wonder of the world. It's really how wealth is generated. It's how you can start with a small amount of money and then eventually grow it to a large amount of money. The example I always use the examples in the extremes, but say you had a trading strategy that made you 100% return every year, right? And you started with $100. At the end of year 1, you'd have $200. And there you have 2 options. One is you take $100 for yourself and you go buy something. The other is you start year 2 and you give that trading strategy $200. So now instead of it making you $100 a year, now it's going to make you $200 a year. And now you have $400. So if you then go and place it back, even though it's making you the same percentage, the 100%, this year it'd be worth $800 and then 16. And it doesn't take too many doubles, which I'll show you, to become a multimillionaire by doing that. We don't have an interest rate, but we have what we're going to risk on your account, and that is R, right? So anytime you hear about R in finance or mathematics or trading or anything, it just means risk. It's one risk unit. For example, I ran the same 4 tests before on the top left here, and I actually then added, and these tests, remember, they were done if you had a $10,000 account and you either made $100 or made $150 or lost $100, right? And it was just that over and over and over again. So each of these trades kind of assume you're either going to make or you're going to lose based off of this kind of system, but you're always making 100 or losing 100. The one in the top left is the one that I just showed you. So how this was done was I just took a random number generator and I said if the trade's positive make $200. If it's negative, lose $100. And I just did that over and over and over again. And you can see good results, right? A $10,000 account into 75,000 after 1,000 trades, right? That's good. But then I ran it again and I said, okay, what if you, every time you made money, you trade it bigger on the next one, and every time you lost money, you trade it smaller on the next one. If that first trade you made $200, your next risk would include that gain, not the full 200, but you're always risking 1% of the value of your account, right?
Okay.
So as the account grows, you're risking more and more and more. Mm-hmm. And that's the chart on the right where you can see in the same 1,000 trades, it's gotten to $20 million. That difference should show you the importance of this compound. That small difference of...
So why aren't you doing this?
This is exactly what I'm teaching you. This is what I do as well.
Okay, so how come we don't have $20 million yet?
Sorry.
You must have placed
I'm
over
training you to do
trades.
it. Yeah, but assuming all of them had, in my entire life, my career, had a 2-to-1 risk reward and a win rate throughout, and I didn't need to withdraw any of it to pay us money or feed us or pay for weddings or anything. I'm hoping you'll get there. I'll pay all the bills, and I'll start with 10 grand and make 1,000 trades and then come back with 20 million. It's obviously not that easy. I used extreme examples to give you the point. The same number of trades, just with compounding risk as opposed to non-compounding risk, is that difference. It's the same win rate. It's the same everything. So this is the non-sexy part of trading that people don't want to talk about. But away it goes. Now's where the math starts. Are you happy? Now's where this was all just theoretical examples, okay. Right? We're going to start you off with a 1% risk per trade. I consider that a good number anyway. It means you need to lose 100 trades in a row to wipe out your account.
Okay.
Right? And through probabilities, that shouldn't happen. In theory, it could. I always, still to this day, I usually risk between 0.5% and 1% of the value of my account. Never really over 2%. Unless I'm doing something that's like a speculative account. But a good rule for you guys and a good rule for you is 1%. If you're doing really, really well and you're really confident, maybe 2%, but stop it there. And that's because of the law of large numbers we went over in the other course, right? If you were risking 5% of the value of your account, if you had a 50-50 win rate, you could in theory have 10 trades losing in a row. And if you're risking 5% of the value of your account, you've just lost half your money, right? Whereas if you lose 10 trades in a row here, you're down 10%, which sucks, but that should just be one really good trade or two good trades the other way. You take the size of your account, say it's 10,000 to start with. You multiply that by 0.01, so that'd be $100. So at that moment, you're risking $100 per trade. Then after every single trade, you recalculate the size of your account and times it by 0.1. It doesn't have to be every trade. Some people will do it once a week. Some people will do it when a milestone's hit. So maybe every time they make $1,000, they redo it just to stop them from having to do the math every time. The more frequently you do it, the better the results. So I would say once a week would probably be like the longest time that I would leave it. One of the accounts that I use that I'm trading with the other guys from Trade Ideas, we just use every time we make $5,000, we reevaluate, or if we lose $5,000, we reevaluate the account. So then here's the formula for what your position size is. Now that we know R, because you've seen this in your own kind of paper trading you've been messing around with. Sometimes you take a trade and the stock rips in your favor and you've made like $50. And right, sometimes you take a trade and it looks like the stock barely moves and you're up or down like $1,000, right? So this is how we normalize that so that every single trade risks the same amount. It's with this equation. Don't worry, I have examples with pictures. I know you don't like math, so I put in examples. Here's a just random chart, right? So you take your entry, 5.63, right? You say that's where I want to get in. In that area, these will all be, rounded type. You don't need to be exact. Because you'll never be exact with your price in. You'll never be exact with your price out. You always want to err on the side of caution. You know what I mean? If you're rounding, round down, not up. You're going to enter at 563. and you know you're going to put your stop. I just wrote in 523 under
What do
those
you
lows.
mean if you're rounding round down? If you want to enter at 563, you would put that at 560? Is that what you mean?
No, I just mean for the sizing at the end. Because
Okay.
just assume that you're, that if you say you want to get in 563, assume you're going to get filled at 565, 570. If you're going to stop at 523, assume you're going to actually get out at 520, 515, right? So when we get to the bottom, the end is 625 shares. I would probably just round that to 600 shares and send out that order. But yeah, so you take your entry, 563, you take your stop. That's 40 cents risk, right?
Mm-hmm.
Then you take your current account size. I put 25,000. And then your risk is 0.01 of that, so $250. And then you divide your $250 by your 0.4 or your 40 cents. And then there's your share size. I have more examples, don't worry. So simply put, you take the dollar amount you want to risk, and then you divide it by difference between where you're going to get in and your stop loss. Here's another. So if you're going to enter here at 2010, right, and your stop is 1880, so that's $1.30 risk. So you take the risk, which I've calculated out $260 in this one, and 1% of that account. Take the $260, divide it by 1.3, you take 200 shares. Now, the beauty of it is we can set up trade ideas to do this math for you in a lot of cases.
There's a beauty of it because...
But it's very important. So you got to think. So there's
Okay, let's go back to the math here.
Right, but let's simplify it. So you got two parts of the equation, right? Look at the very bottom line. That's your share size equation, right? So the two parts of the equations is how much am I going to risk in a dollar terms? How many dollars do I want to put on the line, right? What's your bet size in poker?
Okay.
What is the amount that I'm okay losing in this trade?
Okay.
That's half of the equation, right?
How do you get that?
That is 1% of whatever the value of your account is going to be. So the simulated account you have with Trade ID is $100,000. So you would risk $1,000.
What I'm not understanding here is current account size is 25,000. So why are we doing
26?
So that's a typo.
Oh yeah, it's a typo. So below that, where I have 26 times 0.1 is $260.
Okay, so it should be 25 times 0.1.
Well, that one's 25. So I'm assuming you made money on this trade. And now you're at this trade.
Okay.
To show that you're going to be risking, even though it's 1% of your account, because your account has gone up between this example and this example, your risk has gone up from $250 to $260.
Okay.
Right?
I understand you.
But
now.
yes,
But your
current account size,
is...
that should read 26,000.
Okay.
Yeah, that's right.
Okay.
So that's one half of the equation. And that one's pretty easy to do, right? Take your account size, find 1% of that account size.
And that's how much money you're going to risk.
That's how many dollars you are going to get taken from you if you're stopped out.
Okay.
Then you need to find out what's the size of your stop. And that's just where you're going to get in versus where you're going to get out. You just subtract those two, right?
Okay.
So I'm going to get in at 2010. I'm going to get out at 1880. So it's $1.30 in risk.
Okay.
Then you take the amount of money you're going to lose and you divide it by that, and the output's your share size.
Okay.
So then now you can sit down, you can look at a chart, and you can say, I want to get in here, and I know I'm wrong here. So you see why, I waited to teach you this, because you need to know what you're going to be buying and why and where the stop is going to be, and that's where we taught all the patterns, right? But you can see how I hope that this gives you a little bit more of a clarity that when you sit down and say, I see this ascending triangle.
Yeah, like right now I'm just like, buy 100 shares. That's all I'm doing.
Well, that's what I told you to do because you didn't know this part.
Yeah.
But the beauty of this is now you're going to be in a thing where every time you're wrong, that like I can't. It's one of those things that you don't know. And this is more for the people watching, the people who are trading and struggling. Most people that are trading and struggling aren't doing this. And I was the same way for years, where I was trading and struggling because my equity curve would go up, 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 and then I'd take a big hit and it'd tank again. And it'd go up, 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 up. Now that I risk this constant amount on every trade, the equity curve flips, where I'll lose, I know exactly what I'm losing every time, and then you get a blowout trade. So this is what we're going to talk about with using R for rewards. I put what makes a good trade, saying to make money is useless without knowing the risk, right? So it's like if someone came to you and said, and you couldn't see them, right? And they said, I benched, 400 pounds. You'd be great. How big are you? How long have you been lifting? Right? If it was a 50-pound woman that said, I benched 500 pounds, that's impressive. If the dude weighed 500 pounds, you'd be like, well, it's still a lot of weight, but it's not as impressive, right? So if someone comes to me and said, I made 10 grand on this trade, doesn't mean anything. If you risked $100,000 to make 10 grand, it's a stupid trade, right? So what I've done, this is just in TradingView software, I am taking this Bitcoin trade, right? So I can say now that I'm shorting it in this area, right? My stop is just this big red line up here, and my target is down here. So it calculates out that I'll make 4R. So now that you have this side of the equation, you can kind of put it all together, right? So if you're, for example, if 1R is $250, right? You know that that's one of your risk. And you know that you should be making double or triple your risk on a good trade. You need to look at it and you say, okay, is there a chance that I can make $750 on this trade? So what I need to do that, if I know that 40 cents is my risk and I'm trying to make 3 times that, is it, what's that, $1.20? Is it possible that this stock could move $1.20? Do I think I could get to, what's that, 680? Right, up in here. And that's part of your trade evaluation now, because you're always going to risk 1R. It's that R number is going to change after every trade, but you're always risking 1R. So you just need to look, and you'll never know for sure. That's the guess, right? That's the bet. But is it feasible? Like, do you look at it and say, this isn't outside of the realm of possibility that I can get 2R to 3R, right? Could I make 80 cents in this one to $1.20? And if yes, take the trade. Because now it's just a math equation. If you're right 50% of the time, as we showed here, and you can make 2R by risking 1R, which is what this math equation is, then you know what your equity curve will be, and you know what your compound equity curve will be slowly over time as you learn. So does that make sense?
Kind of.
Any question about R trading?
Not yet.
Let it sink in. But the main takeaway is this, which shows the importance of it, and it's this which shows the math. Now that you know how to do the math, when we sit down later today or whatever and do our scanning for what you want to trade for this week, it's not just going to be take 100 shares. It's going to be sit down and do this equation, figure out how many shares you want to take on each trade. Make sense?
Yeah.
All right. So again, guys, give us a follow here. If you're watching the video on my channel right now, she will have the next one. She's going to start doing her own videos soon.
You've been saying that for a while.
I know. All right, that is it for this one. I will see you guys in the next one.